Alright, welcome to topic 5 of Financial Reporting Unit. Our discussion will focus on share capital and dividends distribution. When you define equity, it is simply assets less liabilities, and it has also been defined under conceptual framework. In shareholders' equity, we have major accounts included. The first one is share capital. This is relating to the ownership and funds of the owners of the company. Reserves will include revaluation surplus, general reserves, forfeited share reserves, and other reserves by the company. Retained earnings are accumulated losses or accumulated income of the company. When we talk about ordinary share, this is the one that we commonly known as voting shares. They have the right to vote on many occasions pertaining to company. And also, they are entitled to have dividends, but there is no guarantee of dividends for ordinary share. Again, depending on the profit or profits accumulated by the company and declaration of the board to distribute. Unlike accruals, dividends which are not paid doesn't automatically mean that it will be paid in the future. Again, when you talk about dividends, if it is declared, then that will be the time that it will be possible to be distributed. But if it is not declared, then no dividends will be received by the shareholders. Preference shares have preference in certain receipt of dividends or distribution of assets. They have some voting rights, but some preference shares doesn't have the voting rights. For preference shares, we have different types of preference shares. We have the participating, convertible, and redeemable. When you talk about participating, the preference shareholders can receive dividends at a fixed rate and also can participate with ordinary shareholders in profits distribution. So which means they can receive at a fixed rate certain dividends, and at the same time they can also share some profits distributed by the company to other shareholders. Convertible, on the other hand, is where your preference share can be converted to ordinary shares. Redeemable preference shares are shares where company will be able to redeem the shares or the preference shares at a specific date. Now, preference share has some characteristics of equity and also debt. Some preference shares have the characteristics of equity or debt. Now, when a preference share has both equity and debt characteristics, the dividends that the company is paying is treated as an expense. It should be noted, when you say dividend is not actually an expense. But if the preference share has the characteristics of being both equity and debt, which means they will be receiving interest on a fixed date, then the dividends received by the preference shareholders will be treated as interest expense. Now, as we have discussed a while ago regarding share capital is the balance of the owner's equity within the company, which is comprising of the fund contributed by the owners. Now, the term share capital will include, of course, ordinary share and preference share. Now, our discussion will be focusing on how to journalize issuance of share, partly paid shares, and also oversubscription. Now, basically, this will be the entry, as you can see in the PPT, as you can see in the presentation. The first transaction is the receipt of application monies. So for the company, when they issue the share, they will invite investors, and the investors will, of course, pay cash. But when they pay cash, it will be first deposited on what we call bank trust. So whatever amount that the investors paid, we will record as debit trust and credit application. Now, there are chances that the subscription or the application will be more than what the number of shares will be issued, and that actually creates some accounting adjustments or may require some accounting adjustments. So later on we will discuss. The next journal entry is when all application had been received for the shares. Then the next entry or the next transaction is to issue the share. So when they issue the share, it will be debit application and then credit share capital. Only after this, then the cash will be transferred to cash at bank. Take note, if it is under bank trust, the company is not supposed to use that money. But if it is transferred to cash at bank, then the company will be able to use the cash. Partly paid shares are shares basically paid partially, and the subsequent payment will be done on an installment basis. And in this case, there is an effect or there is a recognition of what we call receivable. Now, where no future date has been specified for calling up the unpaid portion, an asset is not recognized until the company has specified a future date or dates for calling up the unpaid portion and informs shareholders of these dates. However, where shares have been issued on installment basis with an amount to be paid on issue and with further amount payable at specified future dates, a receivable must be recognized. Now, we will not recognize accounts receivable on this case, so we will use a different account title. A while ago, I mentioned about chances that the subscribed shares or the applied shares by the investors may have been over subscribed to the number of shares that will be available for issuance. So in this case, if there is an oversubscription of shares, we have to either refund it or we can provide a pro rata basis on the subscription of shares. So when you return the excess money, you have to debit application or credit bank trust or allotment. Allotment is the receivable, so-called receivable account used in this transaction. Accounting for dividends, the directors has the power to declare the dividends. Now, the dividends should be paid out of the retained earnings, or we call it unrestricted retained earnings. Dividends can be paid or may be paid in form of cash, bonus shares, or assets. Bonus shares effectively capitalize earnings, so which means you're transferring your retained earnings to become share capital. In that case, no cash distribution, but the company will distribute share. Now, Australian accounting standards prohibit the recognition of dividend at the end of the reporting period, unless the dividend has been declared prior to the year end and the payment of the dividend does not require further ratification by other parties, such as by shareholders at the AGM. Now, accounting for dividends, we have two types of dividends. We have interim dividends and final dividends. Interim dividends usually paid within accounting period, but final dividends usually declared at the end of the accounting period. So basically, if it is interim dividends, the payment of interim dividends will be debit dividend paid and then credit cash at bank. And then afterwards, at the end of the accounting period, you have to close dividend paid to retained earnings. So that will be debit retained earnings and then credit dividend paid. Final dividends, when it is declared, that will be debit dividend declared and then credit final dividend payable. Then afterwards, same with the interim dividends, you have to close the dividend, in this case, declared to retained earnings. So debit retained earnings and then credit dividend declared. And then when you're paying for the dividend, debit final dividend payable and then credit cash at bank. With regards to redemption of preference shares, it is redeemable out of profits and also out of proceeds of fresh issue of shares. Journal entry: So when you issue preference share, so debit cash at bank and then credit share capital preference share. And then to eliminate preference shares and create capital redemption reserve, so debit share capital preference share and capital redemption reserve. This is the time that you're planning to redeem the preference share. Now to redeem a preference share out of profits, you have to debit retained earnings and then credit cash at bank. And then to increase the balance of share capital, debit share capital redemption reserve and then credit share capital. Alright, forfeited shares are shares that partly paid but did not receive any subsequent payment from the subscriber or from the prospective investor. If there is a forfeited share, the shareholder will cease to be a member of the company. So obviously, if they didn't pay the share, and if we forfeited the share, we are actually trying to say that the subscriber will not be a shareholder anymore. Shareholders who have forfeited shares might be entitled to a full or partial refund. Now, this will be the rule. Take note of this. If the company is listed on ASX, or if the company's operating rules allow it, a refund is paid to the investor less cost incurred in reissuing shares. So the amount paid are recorded in the forfeited share account, which is a liability account until it is refunded. If the company is not listed in the stock market and the Constitution says nothing about refunds, the company can retain the amount paid less cost of reissuing shares. The account to be used will be forfeited shares reserve, which is part of the shareholders fund. This will be the journal entry for forfeited share. Now, when you say to record the call, that call is when you're asking the subscribers to pay the amount which is outstanding. So that it is like a receivable also, same with allotment. So debit call and then credit share capital. Now to record forfeiture of share, you have to debit the share capital based on the amount subscribed. So that's debit share capital, credit call, and then credit forfeited share. Now the call is of course the equivalent amount of the unpaid portion for the share capital. Now when the company is able to sell the shares to a different shareholder, that will be debit cash at bank, debit forfeited shares, credit share capital. And then if you are recording the refund, that will be debit forfeited shares and credit cash at bank. To take note, for the second journal entry here in the presentation, it is signifying that you are removing the shareholders as a shareholder of the company. So that is the entry to remove or to cease the ownership of the shareholder with regards to that share. Now, share splits and bonus shares. Share splits is to subdivide the company's share into shares of smaller value. So when you do this, for example, if one share, they will have a share split, make it 2, and that share has a value of, let us say, 10 kina per share, and then they split it. The cost per share now, after the share split, will be $5. So from $10, it will be $5. No required journal entries for this, but at least you have to record it in one of the books of the company regarding share split. Now, bonus share is issuing of additional shares to existing shareholders. It will be at no cost. So what will happen? There will be debit retained earnings and credit share capital ordinary share. So it's signifying that the company paid dividend, but instead of cash, they are distributing shares. Rights issued and share options. A rights issue provides existing shareholders with the right to acquire additional shares, typically at an attractive price. So if you are a shareholder, you have actually rights issue inherent with that share. So when company wants to issue shares, every shareholders will have the right to acquire the shares at a price which is usually lower than the market price. Now, with regard to share options, it is a common practice for the company, especially if they have an employee who are loyal, or let us say had contributed so much with the company, to pay or to issue share options. When you're given a share option, okay, you have actually have the right to acquire shares in the future if you want to acquire shares of the company. Of course, there will be a set price on that, but usually you will exercise the option if it is favorable to you, if you are the employee. If shares are issued to employees, then they will be treated as part of salaries expense and then credit share capital. The last one is reserves. Reserves includes revaluation surplus, which we had discussed in topic 2. General reserves may be used as a means of transferring profits out of retained earnings for future expansion plans. So it's actually signifying that you have enough profits to provide future expansion. So to create this, you have to debit retained earnings and credit general reserve. That ends the video recording of topic 5 lecture. Thank you for watching.